This is Chapter 23 of Accounting 202, Relevant Costing and Managerial Decisions. I will be reviewing the highlighted learning objectives. First, we will look at the importance of relative cost for short-term decisions. In making short-term decisions, managers focus on costs which are relevant. Relevant costs are ones that make a difference. They're also called incremental or differential costs. So these are the additional costs that are incurred if a company pursues a particular course of action. Management also has to consider incremental revenues, which are the additional revenues generated by selecting a certain course of action over another. So three types of cost are pertinent. They include sunk cost, out-of-pocket, and opportunity cost. Sunk cost cannot be changed by any decision we make because they've already been incurred. So a sunk cost cannot be considered in the decision-making process. If you bought an automobile 2 years ago for $15,000, that amount is a sunk cost. No matter what you do with the car, you cannot change the fact that you've already spent $15,000 for that car. An out-of-pocket cost is a future outlay of cash, which is associated with a particular decision alternative. Out-of-pocket costs are relevant because they're future costs that differ between alternatives. For example, if you are considering taking a vacation or staying at home, you will have travel cost, out-of-pocket cost, only if you choose the vacation. Opportunity costs are the potential benefits that are given up when one alternative is selected over another. Opportunity costs are not actual dollar outlays, but they impact our decision. For example, the opportunity cost of attending college is the lost salary that you could have earned by working instead of going to school. Now we will look at evaluating make or buy decisions. The decision to make or buy a component is common. The decision involves the question of, is it more economical to produce the goods internally or purchase them from an outside supplier? We will again look at the incremental cost for the decision. Incremental cost will include direct materials, direct labor, and incremental overhead. Here's an example of a make or buy decision. Fast Track currently makes Part 417 with unit costs that includes direct materials, direct labor, and factory overhead. The normal predetermined overhead application rate is 100% of their direct labor cost. An outside supplier offers to make this part for us and sell it to us for $1.20. We know that $1.20 is less than their current $1.45 unit cost. So should they stop making the part and buy it from the outside supplier for $1.20 a unit? We know that they will avoid the direct materials and direct labor cost, but that comes to only 95 cents. So they're not going to pay $1.20 per unit if they're only avoiding 95 cents per unit. So that means they also must be able to avoid some of the factory overhead, but how much of the overhead would they have to avoid in order to justify buying the part? So they have to be able to eliminate 25 cents per unit, which is the $1.20 to buy minus their 95 cents for direct materials and direct labor. That's how much they would have to eliminate in the factory overhead costs to justify buying the part. If the avoidable amount of factory overhead per unit is 25 cents or greater, then they can consider buying the part instead of making it. On the other hand, if the avoidable amount of factory overhead is less than 25 cents, then they should continue making the part. So if we're assuming that management computes incremental overhead at 20 cents per unit if they make the part, then they should continue to make the part. Now we will look at a sell or process further decision. Many products can be sold in an unfinished state or processed further into a finished product that will sell for a higher price. The decision to sell or process must be based on incremental revenues and incremental cost. The cost of manufacturing the product up to the sell or process decision point, those are sunk costs and are not relevant. So in this example, Fast Track has 40,000 partially completed units of a product called Q that can be sold now for 50,000, or they can process product Q further to make products X, Y, and Z. Processing further will cost an additional 80,000, but will yield total revenues of 150,000. So what should Fast Track do? The incremental income from processing further is 70,000, as you can see here, 150,000 revenue minus the cost to process further. This is greater than the incremental income of selling it now, which is 50,000. So they should process it further because it will yield them an additional 20,000 in income. We'll look at another variation called scrap or rework. Manufacturing processes sometimes yield defective products, so managers must decide whether to scrap or rework those products. If they are reworked, the products can normally be sold for a higher price. So the decision to rework or sell as is based on incremental revenues and incremental costs. So we're going to look at an example here where we assume that Fast Track has 10,000 defective units that cost $1 per unit to manufacture. They can be sold as is for 40 cents a unit or reworked and sold for $1.50 a unit. The cost of reworking the defective units is 80 cents each. That $1 per unit original cost to make the defective units is a sunk cost and irrelevant. The 40-cent selling price of scrap is the opportunity cost of reworking. So what should Fast Track do? You can see in the bottom schedule that the bottom schedule shows us that they will actually have more income per unit if they rework the units. So they would only get 40 cents per unit by scrapping them, but they will have 70 cents in incremental income if they rework them. Now we will look at something called sales mix. When a company sells a variety of products, some are likely to be more profitable than others. So management wants to concentrate on the most profitable products, especially if they have limited resources. So management must identify the most profitable combination or sales mix of products. We're going to look at something called contribution margin per unit of scarce resource. So here, Fast Track produces product A and product B, and the selling price and variable costs are shown here in the top table. They have excess capacity of 100,000 machine hours per year. Product A uses 1 machine hour per unit, and product B uses 2 machine hours per unit. With limited resources, Fast Track needs to focus on producing the product that yields the highest contribution margin per machine hour. Even though product B has a higher contribution margin per unit, product A has a higher contribution margin per machine hour. So in this case, Fast Track should produce as much of product A as it can up to the market demand. You can see the decision rule in the bottom. If the demand for products is limited, produce the most profitable product up to the point of total demand, and then use the remaining capacity to produce the next most profitable product. Now we will look at segment elimination decisions. Managers have to consider eliminating poorly performing segments. We're going to look at an example from Fast Track, whose treadmill division's total expenses are greater than its sales. We can see the total cost for the treadmill division. So we need to know how much of that is avoidable or eliminated if we decide to eliminate the treadmill division. So a segment is a candidate for elimination if its revenues are less than the avoidable cost. This shows that if we eliminate the treadmill division, we will avoid total cost of $41,800. The last column shows the unavoidable expenses. So $6,500 of the expenses are unavoidable, meaning they will be incurred even if they eliminate the treadmill division. So those costs are irrelevant to this decision. So we're going to focus on the avoidable expenses and revenue. Because the division sales are $47,800, eliminating the division would mean their income is reduced by $6,000. So we take the sales minus the avoidable expenses. The decision rule is that a segment is a candidate for elimination if the revenues are less than the avoidable expenses. So in this case, we do not want to eliminate the treadmill division because the revenues are greater than its avoidable expenses. We will look at how to evaluate keep or replace decisions. A keep or replace decision has to do with purchasing an asset. So we want to look at reduction in variable manufacturing cost with purchasing a new piece of equipment. Is the reduction in the cost greater than the net purchase price? If so, then you should replace the equipment. The net purchase price is its total cost minus any trade-in allowance or cash received for trading in an old piece of equipment. Currently, Fast Track has a piece of equipment with a book value of $20,000 and remaining useful life of 4 years. At the end of the 4 years, it will have zero salvage value. The market value right now, though, is $25,000. They can purchase a new machine for $100,000 and receive $25,000 for a trade-in of the old machine. The new machine will reduce their variable manufacturing cost by $18,000 per year over a 4-year period. So 18,000 times 4 is the 72,000 reduction in variable manufacturing cost. So this shows that Fast Track should not replace the old equipment because it will decrease net income by $3,000. The decision rule is if the reduction in variable cost is greater than the cost to buy, then you should replace the machine. We are looking at a special offer decision now. Sometimes a company may have the opportunity to accept additional business. The decision to accept or reject the additional business will use incremental revenues and incremental cost. Some of the cost may not change if we accept the additional business, and so those costs are not relevant. Here's an example for Fast Track. They make 100,000 units of a product that normally sells for $10. We are assuming that they're operating at 80% capacity, meaning they can produce additional units. The total cost to make one unit is $9, so that's why they have a profit per unit of $1. So a current buyer of Fast Track wants to purchase additional units of the product and export them. This buyer is offering to buy 10,000 units at $8.50 per unit, which is $1.50 less than the current price. The offer price is low, but Fast Track is actually considering the proposal because the sale will be several times larger than any single previous sale, and it would use their idle capacity. We can see from this analysis that the additional business at only $8.50 a unit will increase their net income by $20,000. If we decide to accept this one-time special order, revenues will increase by $85,000, which is 10,000 units times $8.50 a unit. The variable manufacturing cost will be the same as normal for direct materials and direct labor, which is $3.50 and $2.20 respectively. And the variable part for overhead is 50 cents a unit. Then we have some incremental costs. The other costs are selling expenses, which are incremental just for this order, will be 20 cents a unit. Fixed overhead will not change, so therefore it's not relevant. And they will incur incremental administrative expenses of $1,000. So these are the additional fixed costs due to the special order. So comparing the incremental revenue of $85,000 with the total incremental cost of $65,000 means that we will have $20,000 in additional income. So the decision should be to accept the additional business. This concludes the recorded lecture for Chapter 23.